informal chat focused on private investing. In INSEAD community, I mean, where we all are together, there has been a discussion a lot of time where people are looking to invest in private companies, pre-IPO, angel investing, venture investing. I mean, it's an idea that comes across a lot, and a lot of question comes with it. A lot of us are quite new to this, so I thought, I mean, let's get on a chat and discuss some basic stuff that is involved here with some of us who have done it. And yeah, I mean, and let's see what questions and queries people get about it. So let me invite Alex to introduce himself, and then we kick on the discussion.
Hello, Sachin. Thank you very much. I'm a Gemba 15A. I've been working in the finance industry for some time across Europe, being with Switzerland, Singapore, and London. Now I'm back in Switzerland and have increasingly got involved in private equity, as I see that, as Claudia Zeisenberger says, since the 70s, private equity has provided 8 times the returns of the public markets. So as an investor, one has to actually take a stake into private equity if they want to have a purchasing power hedge in their way of life. At the end of the day, it's not only about having an inflation hedge; it's about having a purchasing power hedge. So increasingly, myself and my clients have taken more and more steps into the private equity world, more into the late and growth stage. Venture capital is on the radar, but tougher to get into and tougher to get returns. According to Claudia Zeisenberger, venture capital has provided since the 70s a 1.2x on the public markets. So sometimes you inquire as to whether going through a fund in venture capital provides the appropriate risk return. I've also, since 2015, where I did INSEAD, I've set up a couple of startups. Some of them didn't come to fruition until the end. Now we have a startup that is active in the circular economy, closing the loop, allowing brands and customers to return all their products back to the brands. And this is where I got my most hands-on experience into the early stage of venture capital.
I think that's very helpful, Alex. Alex, before we go into like questions, I just wanna help you to elaborate. Like, for example, like my background is engineering. So when I was thinking about private equity before I went for my MBA and learned more about business and finance, my idea was private equity is the people who put their money together, or company who put their money together and buy a company which is distressed. So like the 80s version of leverage buyout comes to me. I mean, like the movies and books you saw, the barbarian at the gates. But when I started doing it, I learned it's quite a lot. I mean, it's a pre-IPO investing, it's venture. There is alternate investments, like people are doing real estate investment for completely uncorrelated returns. Sometimes. So what are the different areas like it covers? Because it's quite wide. So if you could bucket in few areas, because that will really help everyone in the INSEAD community to understand.
So going across the different funding rounds, you'll go from pre-seed to seed to A, B, C, so B, C, D, and then you have the exit at the IPO usually, or a trade sale. So, the early stage would be pre-seed to A, whereby the company maybe has some revenues, but still needs to establish its business model and explain that it can survive onto the market. When you get to the B, between B, C, you have the growth capital, where you have a company that has the revenue but needs to expand from its current marketplace or really establish itself on the market. And then you have the late stage, which is a company that basically is getting ready for an IPO. The kind of private equity that you were speaking about is the kind of private equity that you get from Bridgestone, right? Where the people working at Bridgestone are people that have operational experience. And what they'll do is find a struggling company or a company with potential, it might be even growth, but they get their hands dirty in the operations of that company. What is happening more and more is that private equity is becoming more of an investable class, at which point the people that are dabbling into the private equity don't you can call them dumb money if you want to some extent, because they don't provide anything else but capital, right? You're not going to go, for instance, in the case of SpaceX, for instance, and tell Elon Musk how to run his company. However, you can participate in the funding rounds of SpaceX. And more and more you will have financial services providing access to such opportunities.
No, I think that's helpful because to me, like when I started in private equity and I mean pre-IPO investing, to me there was a bit of learning phase. What are the different kind of products? Okay, I mean normally we came from a background where we are buying index fund, mutual funds, stocks of companies. So to me it was quite a learning experience. Like there are different kind of products, they carry different risks. The due diligence is different. So yeah, I think so. Thanks for the explanation. I think you have given it. It's very helpful. In the meantime, Karim has also joined. So Karim, just for information, for the timing, we're just having some basic discussions with Alex, and then we'll open it for the panel and for the questions. So Alex, I mean, like, hey, so Alex, moving forward, like, so this discussion we want to focus on private equity from average person point of view, like because people who are new to it and people who are looking to diversify or who have only done like stock investing and simple investing or real estate investing until that point. What are the hurdles one person has? Like, for example, I reach to you and I say, Alex, could you help me for some investment? So what are the different hurdles I need to pass before I'm allowed to do it?
Well, the private equity is actually a complex class of investment, right? So you need to be a professional investor, someone that understands how the inner workings of a company, right? Because first of all, the ticket sizes are much larger. And second of all, these are liquid investments. So the time horizon in which you must remain is, I would say, at a minimum 2 to 3 years, often much longer. So you should be able to understand that risk. You have to appreciate that risk, and you should be able and capable of sustaining that risk, the risk of illiquidity. Many times, there are secondaries, so you could exit a position, but that is not at all given. So at the first stage, you have to understand the risks that are involved in that. The problem with private equity is that unlike the public markets, there's very little information on these companies. And there are many people that do brokerage of private equity with smaller tickets, but to actually, and this is it's quite difficult, to actually be able to translate in the private equity space the valuation of a company, which is quite available out there, to the price per share is not an easy task. So often when you go out on these brokerage platforms and you say, yeah, I'm buying a certain company like Snowflake at, say, 500 a share, you don't really know what that represents. You really have to go into the company, speak with the company itself, get access to financial reports, see all the outstanding shares out there, and do work your way back to what the valuation represents in terms of price per share. So you have to be able to do that. If you're not able to do that, you have to leverage on the shoulders of somebody else that can do that for you, and hopefully in a jurisdiction that has a legal framework that disallows him from shirking, right? That makes him actually follow suit and not lying. So the limited access to information and the ability to understand that information is key to investing in private equity. But once you have that capability, the upside is significant.
No, I think that's very helpful, and I agree with you. I'm a big fan of these platforms which has democratized the private investing, especially in pre-IPO space for a lot of investors. But my personal experience, and without taking any name of these platforms, what I saw, like some of these platforms, it's very difficult to get even access to allocation. It's like they will open at a certain time, and if you are 1 minute late, it's gone if the company is out. Another thing I have seen is like when you are doing and you're buying as an express deal or deal afterwards, the valuation there is no way to gauge valuation. I mean, like for example, I have a position in a company and that has a certain valuation at this particular time. And other day I was seeing that somebody is selling the share on one of these platforms, which is almost 50% premium. And this company has quite sizable valuation already. So there is no, I mean, it's somebody who doesn't know that part, like mentioned, like what's the valuation look like, what is the right valuation. There may be a chance that there is a funding round that happens, and which happens even lower than the valuation this person is buying. That information is not available. The second experience I have seen is, and this is another one which is different. So this is the same, but here you get a dedicated relationship manager. But every time I ask the person about a company, and if it is not available, he always tries to push me a few more deals which are currently active in that. Okay, why don't you look into this? And since I'm a small investor, my idea is like, okay, I pick company and I want allocation in that company. I'm not open to a lot of investments. So these are the two kind of struggle I see. So in my experience, what I saw that people who are new to private investing and go to this platform, it's a good place to start with. But if this is something what you want to do, you have to take a longer look also, because yeah, I mean, you have to have access to the information. You have to understand like how to identify what a unique selling point in a company, and what's the best way to enter. A lot of time, for example, as I saw, I mean, in SpaceX recently, and one of my friends shared that he recently got a share. I mean, some of the shares in secondary for SpaceX was already above $100 billion valuation. I mean, so to me that was, I mean, nobody knows. I mean, the SpaceX was last valuation came as 74 billion. So to me, even like somebody who owns a piece of SpaceX, even a smallest piece, to me even that was something which was quite surprising. So that's the kind of I wouldn't say like misinformation, but that's the kind of money, and that's the kind of premiums that can happen, and it's not for faint heart people. I mean, that's what I come to learn over the time.
Absolutely, and it all comes back to access to information. I mean, if you don't have the ability to gather that information, even simple things like what markets a company is on. I mean, you might be looking at BlaBlaCar, you might be thinking that it's a great opportunity, but you don't know, if you're not an institutional investor, you don't have access to the company's information about where they currently operate, where they plan to operate in the future, and from that do a simple SWOT analysis. If you can't do that, you might be talking with your friend and he's telling you BlaBlaCar is the best thing, the best thing that's been invented this year, but you're really kind of walking in the dark trying to figure yourself out. And that is not intelligent investing from my perspective, right? Get the information, make sure the information is right. So when you do invest through an entity that is regulated, whereby the regulator imposes transparency and truthfulness on the institution that you're investing through. And if they don't, there'll be repercussions. And then, yeah, be willing and ready to take on that long-term risk and that illiquidity risk.
That makes sense. And I'm glad you mentioned the example of BlaBlaCar, because this is exactly what happened with me. I mean, BlaBlaCar, it was very popular in the INSEAD community when the company was. I mean, because of the, I think some of the founders are from INSEAD, and it was on Yammer, and people were discussing about it. And I was excited. I was looking, okay, let me invest in it. And this literally happened. I had no clue how to value it. I tried, and I mean, person like me is connected. I mean, he can get information, and I failed to value it. And at the end, I decided that better I stay away from it. And so this exactly happened with me in this case. So let me move to the next part. I think this is probably the most important part is, so let's, for the timing, for the discussion, let's put companies into two buckets. Whereas one bucket is companies which are looking seed or angel, like very early stage companies, and the companies which have some revenue growth or up to later stage going pre-IPO. How should one person should approach the selection and the due diligence process of these companies at a very basic level, and looking whatever information is available in public, which could be limited or sometimes indirect? What are the 2-3 things you would advise someone to do?
In the early stage, honestly, things are going crazy. I mean, there are people who are raising 10 million just on a presentation. I mean, it's no man's land nowadays. And I've had clients of mine that seriously, just on a presentation, they're more than happy to put money behind an idea. I think that's ludicrous, to be honest. Like anybody, it's always important to look at the team. These are the principles that we looked at INSEAD, right? In a startup environment, the team is just as important as the idea. And the team is important because you want to know that there's cohesion. Because from my experience, it is not an easy ride. And I think I was actually discussing with one colleague of ours from INSEAD that did a search fund. And we came to the conclusion and we agreed that there's a lot of, I don't know if it's the right term, but moral hazard on the side of business schools, where they sell you this great idea of doing a startup, and it seems all bright and beautiful, the Cinderella story. But in fact, it's a very, very difficult ride, a lot of bumps. And the only way you're going to get through these bumps is by having a strong team. So, and it happens many times, I think, in the VC world, in the early stage, a lot of people think, the founders, they think that they have a great idea, and they jump in and they make provisions that they will be able to be self-sustainable through their startup within a specific time frame. And that is probably, I think, one of the biggest mistakes any founder can do. Because whatever you estimate, it can be earlier, it can be also 3 times later, right? So you have to put a plan that allows you to survive on your means for a longer period of time. And that comes through the team, right? And everybody in the team. Because if you have one guy leaving today, coming back tomorrow, another guy leaving in 2 months, you're never going to get off the ground. So the team is crucial. The idea is very important. And I think we had a little discussion with Rashid also, that it's the product, the concept, the team, and the revenues. Revenues today at the early stage are not necessary, but they're nice. I mean, once you have revenues, it kind of explains that there is a market for your solution. So those 4 things that Rashid actually mentioned are quite key.
No, I think
Going into the later stage, you really have to take a deep dive into the company, do a SWOT analysis. You have to see where it is actually established on its current market, because by looking at its current market, you're kind of doing an estimation of the downside risk, right? If it's established on the current market that it's at, even if it doesn't work on its expansion strategy, you can actually exit maybe at a discount, but it's not a total loss. Then you have to see where the money is actually going to be deployed. So you don't want a situation where the company is raising funds just to raise funds. You want to understand where that money is going to get deployed and in what time frame, and come down to the principles of a simple SWOT analysis of, what is its strengths, what is its weaknesses, the opportunities and threats of that specific company in the new environment that it's operating. I think that today's way of going into even the growth and late stage is always looking at an existing market being disrupted by technology. So you should get from the existing incumbents a good understanding of what the competitive landscape is without the technology overlay, and then you evaluate how that technology overlay will reduce costs or allow better growth to that company going forward. And that's not an easy way, but it's a safer way of evaluating an opportunity.
No, it makes sense, and I'm glad. I mean, like what I saw, when I do private investing, I don't know. I mean, do you follow any metric? I mean, I don't follow metric. I look some simple numbers. I mean, my idea is very simple. Okay, if you have revenue, what's the revenue look like? How it is growing? What's your operating margin look like? Do you have cash position to sustain? Okay, I'm not too much worried about earning. I mean, what's the macro of sector look like? I mean, does it have a lot of tailwinds coming to it? Who is CEO? Who are the other investors in the company? What clients are telling about the company? And yeah, I mean, of course, I mean, you will look in terms of what's the competitive edge. These are the kind of things I try to look in, and sometimes the answer is very convoluted. Because last year, like I remember, I mean, there was a time when I was reviewing 3 companies, and all 3 are great companies. Like for example, it was Strike, Klarna, and Revolut. I mean, all 3 top fintech companies. I mean, and I was thinking which companies to pick. Okay, and I mean, Stripe was already, I think, around 36 billion those days. So my idea was I was looking upside, and now it's like 95, and I'm pretty sure in private secondary it will be higher. So it's like 3x since then. And then I like came to these 2 companies with between Klarna and Revolut. I mean, so I was looking Revolut 5 years, 6 years old, at a valuation of same valuation, which was Klarna, which was almost 16, 17 years old by that time. So on my prelim look, I saw that Revolut has grown faster and bigger in almost 1/3 of a time. So it was good. But then one fine detail caught my eye, and I saw that Klarna was cash flow positive right from the starting until 2019. I mean, I was thinking like, who in the world of startup focus on getting cash flow positive? Everybody loves to burn venture capital money, and that is something that caught my attention. I took a deep dive. I tried to look into like what CEO has said, different interviews over the time, just to see like what he said in 2006, what he's saying in 2012, what he's saying in 2000. I just wanted to see like how his thinking has evolved, how consistent he has been with the mission. So that got me interested in Klarna. And
that's a very good point that you're raising, because it's investing in private equity, as in startups, depends where you are. I mean, the US mentality to private equity and VC is completely different to that in Europe. As you can very well point it out here with Klarna, he's very toned down, right? He focuses more on having cash flow, being profitable, right? That was building a brand that is more sustainable over the long term, building something that's going to be established in the market for years to come. It seems many times, and this differs between geographic locations and differs between sectors, as you very well pointed out, Revolut. Many times the focus is different. It's about raising as much money as quickly as possible to drive up valuations, to create that buzz in order to redo that round and redo that round, right? So if you go, for instance, in the last mile delivery services or in taxi hailing companies, where it's a winner take all kind of market, you really look at multiple rounds at high valuations before you have an exit, right? So this is expected in that market. When you're looking at a company like Klarna, it's a different ballgame. If you're looking at the US, it's a lot more aggressive than in Europe. So that kind of knowledge that you just developed, that you've developed not only in the last year of investing or 2 years or 3 years, I don't know how long you've been investing, but from your educational background, is also key. And a lot of it, in the end of the day, is very difficult to verbalize over a discussion. Sometimes it becomes innate to your ability to evaluate an opportunity.
No, I think that's a very, very good way to summarize it. I think in a short way, I think it can be said that there is like no holy grail or a checklist thing that you will always do and it works all the time. Given the company where you are, what's the macro look like, investors have to try to work out what's the outlook for a company look like. And I think one thing which helped me and a lot, and this is where our INSEAD like a club came together also, that people talk about it. People say, oh, I'm thinking this, what do you think about it? I mean, this is a sector and this is a macro I'm seeing, this is how I see it 4 or 5 years, and then a discussion starts around it. And by the time this discussion ends, everybody contributes and you actually build a very good thesis. So in my private investing, I think it's very important to talk to people about it. I mean, reach to your network, ask things, because it's always like 1 or 2 things about company that clicks. And
you're absolutely right. I mean, in the end of the day, there's an expression, right? Wisdom of the crowd. And the INSEAD community is a community that's educated, that's able to evaluate a company's strengths and weaknesses, like we said before, is able to do that logical derivation. And sharing the ideas allows you to, turn every single stone, look underneath, evaluate it, and then make a decision as a group, which is the wisdom of the crowd. So if you can create such a platform, I think it would be beneficial to all the participants in that group.
Yeah. So one question I was very keen to ask, say for example, say I'm someone who is not part of INSEAD. I'm just someone who is working in a job, having a decent salary. I mean, saving some money to invest, and probably not in connection with anyone who is doing pre-IPO investing, because that's where a lot of people are. Okay, how should one develop about pre-IPO investing? Because information is very scattered. A lot of people end up with these early small ticket size platform, but I mean everyone wants. For example, like I get queries from a lot of people like how to enter in SpaceX. When I sell it for a small investor, probably the time to enter in SpaceX was last year. Now the big money is chasing. It's getting very difficult. So someone who is not who is entirely independent, not a very large investor, but at least qualified as an accredited investor, looking to start, how should he do? Where should he look for information, and what's the best way for him to dab? What I see in my circle, there are people who does completely risk averse kind of investing in real estate, index fund, and then suddenly the other part of investing they are doing is in the most frontier kind of a new venture, like somebody who's starting in, I mean, like, okay, he is doing something. So I see like quite a disconnect. On one hand, you are going for index investing. You're not even sure for, okay, you're okay with SPY and Dow Jones, and you're okay with real estate. And then suddenly you put a portfolio of companies, like 20 companies, which are, and the reason they do it is because that's what they have access to. They look in their circle, people are doing a startup and they start putting money into it. But there is a disconnect. It is they're doing it because they have this desire and interest that they want this kind of alpha return, returns in multiples of 10x, 20x, and they don't have the information. So what should one do to develop it, or to reach out his network, or to expand his network in this domain?
Well, unfortunately, I don't think it's always possible. I mean, it's an unfair world. Let's look at it. I mean, the VC world is 1.3 times X public markets. The private equity world, which are larger tickets de facto, are 8 times the public markets. The whole point why, even on the base of it, without, if you just spray and pray, private equity is more interesting than public markets, is because you invest in a company before it goes IPO. The minute it goes IPO, you get all the Robin Hoods that just jump in and inflate your price. In the end of the day, you know, there's an accessibility issue that is privileged to the privileged, right? And this is how the world works.
No, I agree.
What happens is, personally, if you don't have the capacity of dabbling with a couple of tickets of 250K in one opportunity, then what's more accessible is the VC, right? However, it seems to me, and that's why I think on average there's a 1.3x on the public markets in the VC world, is that also to set up a fund in the VC world is easier. Because again, the ticket size are, so every guy that has gone to that has a certain good enough network, has done a business school, thinks he has the capacity of evaluating the opportunity of startups. And he will go there and be able to convince his group of friends to raise 10 million, at which point you do have a VC fund some way, 20 million. To really set up a private equity fund, you need 100 million. You have to be regulated. Right? So again, the accessibility is more difficult. Not every Tom, Dick, and Harry can do it, right? So if in the VC, I would go direct, right? If in the private equity space, always direct for me is better if you can evaluate a company. And I've seen that from my experience in my work. But if you cannot give that diversification, then you should go through a fund. And there's many people in many companies, even banks, that provide good private equity funds. However, there's the downside of the funds. I mean, you end up paying, you base yourself, when you invest through a fund, you base yourself in your decision making on the past performance of the fund manager. Statistically, that's just wrong. I mean, in the past performance does not dictate future performance. If you don't have the capacity, you have to go through a fund. So it depends on your firing capacity in the end of the day.
No, it makes sense. So just to summarize this, I mean, so I think I agree with you on this part, like all deals are not available to all people. You will get access to some deals which you may like, which you may not like, given your position and financial position. I think most important is that for an investor, especially early stage investor, is to keep that this is one of the wealth making tool. So if they are not able to do it, how they can become, or how they can be, how will they be able to do it in future? So they have to keep it and active on the radar, use the opportunity, whatever is available for them, and try to debit whenever is possible. Whatever risk capital they can use it and learn it, build a network around it. And yeah, I mean, it's not a perfect way to do it, but yeah, I mean, it's a rough start, but I mean, hopefully you stay. I mean, it was pretty much in the markets also. I mean, a lot of people who start, opening an account is easy, but running an account and beating a market like what people try, I mean, everyone knows it's not that easy as well. Maybe, I mean, it's easy for a lot of people. At least it's not that easy for me. So yeah, I mean, I agree that and I totally agree. I think you said it well. It's an unfair, I mean, in a way, and because everything is, I mean, even today, I mean, like I want to try a lot of things and access a lot of things. I don't get it. I mean, every 10 things I try to invest, I probably get access to one or sometime one out of 20. So it is like this. And the question is, like, opportunities like this, when they come, you need to grab it. I mean, that time, if you stay frozen, I mean, yeah, I think when the opportunity comes, nail it. I mean, go with the.
So again, in the private equity space, you have the guys that go direct, and then you have the funds, right? In the case of the fund, you commit a certain amount of capital to the fund manager, and you kind of trust that he will make the right decisions for you. Many times, from my experience, there are decisions made by the fund managers which are not just performance, right? It might be, you invest in one thing to get access to another thing. And you as an investor, have no transparency or any decision making as to whether you are committed to that decision, right? So there is a risk there, and often the private equity funds are, and 6+2, 8+2 investment horizon. And when you go direct in the late stage, you're looking at, a company that will go IPO in 2 years, right? You are presented with each opportunity, and you can evaluate that opportunity on its merits. I've had many times people who are 100% convinced about one company, and the other half say it's the worst thing on earth, and then the next opportunity is it just changes, and you have to be able to evaluate it. So going direct gives you more autonomy, gives you more transparency, but you have to be able to put that ticket size in that one single opportunity. That creates a concentration risk vis-a-vis that single opportunity, which a fund allows you to spray. But the fund doesn't give you the autonomy and the transparency that I think is key here.
Yeah, I think that's very well said, Alex. I think this is the right time that I should bring Rachit and Karim on panel as well, and they can pose their questions. Rachit, would you like to go first?
Can you hear me? Yes, I think you can.
Rachit, we can hear you.
Yeah, thanks for the great discussion.
Rachit, just take a minute to introduce yourself as well.
Oh, all right. Yeah, sure. So I'm an INSEAD 19D. I'm not. I wouldn't compare myself to Sachin and Alexandros in terms of private investing or even VC investing, and I think I'm quite new to this. I was more joining in more as a participant to know some of the tricks of the trade, and therefore I think thank you guys first of all for a very informed discussion. I wanted to maybe you guys mentioned a lot about accessibility, and a lot of it is determined by how much capital you have and what is your liquidity position and how much risk you want to take. But let's say somebody has capital. How does he? But he doesn't have the network, right? So how does he start to build one, or how does he gain access to those opportunities which exist, but he doesn't just know about, right? So could you spend a minute or two explaining to us, how can we access such opportunities if we have the capital?
Like I said, you can usually go through funds, and the funds are usually presented by private banks. However, if you want to go direct, usually you'll go through multifamily offices. So multifamily offices, which are kind of like external asset managers, they manage the money of multiple, usually ultra high net worth clients. It's usually the ultra high net worth clients that are able and can appreciate the risk, but also the returns of illiquid investments. And the multifamily offices will then dabble into both private equity, sometimes VC, and real estate. The openness of multifamily offices in terms of onboarding just for the private equity side is not always the case. Sometimes a multifamily office would request you to have all your assets within their structure and manage both the liquid and the illiquid wealth. But there are increasingly such houses that will allow investors to just use their private equity arm and invest in smaller ticket sizes. It's increasing. Some of them I've seen is that you have to commit a certain amount that you can deploy over time. So it's kind of like you still have the autonomy of making the decision where you want the capital to be invested, unlike the fund, but you have to commit a certain amount upfront, right? So become a client with a certain amount. Others, I can't say names because
Yeah, that's fine.
There's other ones that that function in a certain way that allow you to screen each opportunity, gives you not the due diligence itself, but the packages the opportunity in such a way that a knowledgeable investor can, to a certain level, look underneath the hood and then pick and choose, opt in, opt out, and choose the size of his investment, his or her investment in that opportunity. Again, I can't share actual names because it's not the platform.
Fair enough.
We understand that part, Alexandros. Rachid, I can share from my side, and since I work in a demography, and geography also, very close to you. So I was like someone who was doing, index investing. Sometimes goes in a stock, and I used to ask questions like, how do I get access to it? So literally, I had no clue, and what I did was I started asking people in my network, whomsoever I met, man, I want to invest in this. Do you have? And literally 99 out of 100 people had no clue, and a lot of people said it's not even advised. But what happened during that journey? I had one of my friend, and he said, "Man, I'm using this small VC, and has allowed me to invest in this company called ChargePoint." And this is before the ChargePoint becomes such a big name nowadays. Yeah. So you say, okay, you tell me that more details about it. And then when I started asking people, and then you will be part of some community somewhere. There are some message boards. One of the message board I met couple of INSEAD colleagues who were raising funds. So the guys. What kind of idea. So there is a kind of a relationship because of your INSEAD alumni, and you can build that kind of trust. So these are small things. And then I met a lot of other people like Alex, who has advised me a lot of time on what to do and how to do, and help me in ways. So yeah, I think these are the kind of things. So there is no perfect way of doing it. Be aware of it. One thing which I would like to ask Alex from you to you, continuation of Rachid's question is, this has come to me several times, like a lot of people, they don't have big money, but they have ticket size of 50K, 75K, but they're 20 people like this. but they can come together to make a pool of like $2 to $4 million. Okay, and these people have worked together 10, 12 years, so they have trust with each other. Okay, so they ask me like, why don't we put an SPV? Because individually we cannot qualify, but then as a group we have more leverage, and we know each other, we trust each other. I mean, 50K, 75K is a kind of amount. We know we are not going to spoil relationship over that. So is it possible, like people coming together, like for example, I go with some of my friends, say Rachit and you, and we put like $2 to $4 million together, and we say, okay, let's now invest this somewhere. Have you seen things like that happening in journal?
Absolutely, absolutely, and it's a very common structure. I actually, in some cases, ultra high net worth clients have their own structures, like their own family offices, right? And the family officers themselves are not people who are super huge. You know, they cannot take such big bites on each one opportunity. And I've seen multiple family officers, because they go through the analysis of the opportunities, they group up with their other family officers' friends, right? And in the end, make an SPV and invest through that SPV. So they're all looking at that. The beneficial owners, their beneficial owners, take bigger chunks, but then they pull their resources together as family officers, and they invest in the same opportunities that their bosses are investing in. Because I mean, if it's good for their bosses, it's good for them too. So, and they've done all the due diligence. So absolutely, a simple SPV, a Cypriot one. I mean, Cyprus is very good at setting up SPVs. Singapore is quite good, easy and fast, not expensive. You can even set up a Cayman or a Belize one. In the end of the day, it's not an issue. In the end of the day, yeah, the SPV will be set up. We'll pool your resources. In terms of onboarding as a client, each and every one will have to be screened, and that is not an issue.
Makes sense. Hey, when we open SPV, I mean, like for example, say if I take the case of Singapore, for example, I think Cyprus is also same in terms of capital gains on stocks. I mean, there are no capital gains in general in both countries, but when you do an SPV and then you make gains out of it, apart from established fee or managing fee or legal due diligence part, are you exposed to taxes on these gains, or they are still considered as individual capital gains?
Not a tax advisor, and I wouldn't be able to give you a 100% answer, but my understanding is that no. I mean, okay. You have the SPV, and it's just the cost of running the SPV that you're facing.
I agree.
But then as an SPV, nowadays you have the automatic exchange of information. So the information of you as an investor is passed on to your local country, right? And you have to report those capital gains as income in your home country. That's my understanding.
Makes sense. I was pushing my luck with you. I knew, I mean, I'm on tax thing is very sensitive all the time, but I mean, picking your mind is important. Your time is precious, man. Hey, Alex, have you thought about or have you seen SPV as a service of somebody doing like company is
Absolutely.
Doing it?
The whole of Cyprus is set up like this.
Okay, great.
Cyprus is, for different, I mean, now it used to be simple SPVs, because back in the day you would have structures of families with 35 SPVs in them, which didn't make much sense. Now regulation has come in pretty strong to break down those complicated structures, because it's no longer tolerated by the financial industry. And SPVs have a purpose many times as blocker companies, as structures like we just spoke about now. And the Cypriots are moving up the value chain into RAIFs and fund structures, more complicated fund structures. And they're pretty good. Singapore is very good too. Luxembourg is good but expensive. Yeah, that's about it.
Makes sense. Rachit, does it answer your question, this discussion?
No, I think very informative. Thanks, Alexandros. It does answer my question. Of course, we can't go into specific names, but it does give me a couple of insights as to how to proceed forward.
I think, to answer the question, it's exactly what Sachin did. As an INSEAD alum, you have extremely powerful resources at your disposal. I mean, if you want to get involved in this, reach out to Claudia. She is a guru in this space. She is really, really strong. Read her books. They're amazing. And you know, just go onto Yammer, go onto WhatsApp. And the thing is not to be afraid to ask the questions. You know, get yourself involved. You know, I mean, that's the whole point of being an INSEAD alum. You know, going out there, asking a question and getting that support without feeling vulnerable. And if we start getting that ball rolling, like talking and exchanging ideas, it's everybody's going to win, right? That's the whole point.
Yeah, absolutely.
Okay, let me bring Karim on the panel. I think if Karim has a couple of queries, I think he wants to go ahead. Karim, would you like to come?
Hi guys. Yeah, I echo what Rashid was saying. Very informative, very interesting fireside chat. Maybe if I've had one point to talk about is you guys spoke about a few risks, right? You spoke about, well, first of all, the fact that you know, people have to have a risk appetite. You spoke about problems in finding out and determining valuation when you invest in these startups and whatnot. You know, something else that I was thinking about, and I'd love to see what your thoughts are about it, are startups that are based in maybe, for example, Northern Africa or somewhere in Africa or whatnot. There was just the Y Combinator demo days that happened a couple of days ago, and there were some very interesting startups there, maybe based in Egypt or in Nigeria and other such countries. How do you go about doing your due diligence about them, and especially, you know, having been in those countries, you know, sometimes the financials are not 100% representative of reality, is the way that things work in some of these countries. So how do you deal with that?
Are you talking to me?
Yeah. Alex, you go ahead, then I'll...
I mean, in the end of the day, I mean, a startup in Switzerland or a startup in Nigeria is still a startup. You have very limited information. And again, it comes down to using your network to know the founders, right? It comes down to people in the end of the day. And I mean, even LinkedIn, just to think about it, LinkedIn, when it was doing its, I heard the story once, when it was doing its round C, apparently it had something like 10 revenue streams. What it ended up being was nothing compared to what it is today. So that's LinkedIn, right, in the US, right, at around C. So when you talk to the founders, again, in a startup phase, it's, I mean, the idea, what it is and what's going to be, it will be completely different. You're investing in a person, in the drive, in the compassion, in the passion, in the resilience of that team to go through thick and thin, right? And that's what you want. Now, if it's in Nigeria, I mean, it's good. The cost base is lower, right? You have a firing power as a Singaporean. You probably can finance it through your corporate jobs revenues, right? Your income. If you're investing in Switzerland, it's tougher, right? Because, you know, a lot of that income, a lot of that capital will go towards paying the salaries of the employees. In terms of country risk, there's always country risk. So I don't see why Nigeria would be worse than Switzerland. Again, I mean, realistically, if you invest in a startup in Switzerland and the guy leaves with your money, can you really do something? You really have legal recourse? Realistically? I mean, if you're a foreign investor, not really. I can't say you can. Nigeria, the same. If you know the people, good. Now, you carry a country risk on Nigeria. Tomorrow, Nigeria might have a coup, I guess, or something like this. In Switzerland, it's a bit more stable. You know, when you sign, like my startup, we signed a contract with the post office. It's something ironclad. You know, it's a bit different in a developing country.
I think makes sense. And Karim, like in my experience, like I lived in Nigeria. So, I mean, I have, and INSEAD community is as vibrant in Nigeria as anywhere else. I mean, the same thing, like when a deal come to me and it's in Nigeria, people want to go, I connect with this community there. When I was there, I mean, they were like, we had some informal sessions with some of the community member. We had drinks together, dinners. So build that kind of relationship. And I asked them, I mean, I said, man, you tell me, I mean, does it look like good? Recently, one of my another INSEAD alum who I helped him in 2016 in his startup in India. I mean, he did another startup in Morocco. So I knew that guy. I mean, I knew that he has cut his teeth doing this. So when he's saying something about this idea and fintech, my ears are open. I mean, I'm helping him, meeting other people. And then what happened was another INSEAD alumni from India. He was looking to expand into Morocco, and this guy was, so basically we got into a kind of situation where one was helping or guiding. Okay, you want to come in Morocco? What's the regulatory environment look like? What's the approval environment look like? What you can do? Do you need a local partner? So that kind of guidance comes with it. I mean, the law of the land could be different, but I think industry wise, what I'm saying is that this venture capital and startup mentality and regulation is improving, and governments are actually recognizing it. So still, I mean, for example, I mean, another friend I'm helping whatever I can in Switzerland. I mean, in his startup, along with Alex's, and same. I mean, I'm in Southeast Asia. I mean, and I try to bring perspective what I think is valid here. So yeah, I mean, it's like Alex said, the risk is there all the time. Its nature is different, but if the team is solid, idea is solid, and there is focus on execution, yeah, I mean, yeah, I mean, you will do. Comfort level will take time. I know guys. I mean, I know friends in Malaysia who are very comfortable spending or investing now money in Indian startups. They keep asking me, okay, what is the next fintech startup? We need to know, because over 4 years back, it wasn't like that. They were really scared. They will ask me, okay, do we really go? I mean, what happens? But now, like over the time, so I think this is one of the indicator I take. How many startups have raised funding in a given country? Which are these investors? So if I see there is a flow of investors coming to that country, I would take it as a very initial proxy that there is an acceptance, and probably there is some more clarity that how yeah, what's the legal framework or the regulatory framework is looking in. I mean, again, like Alex mentioned, is yeah, it's every time it's a new game.
And I would there are different ways of looking at startups in each developed and developing countries. For instance, you have to read when you read the news, for instance, climate change is a huge issue, right? But I wouldn't specifically, like, I would go into a developed country to invest in climate change because the people in those developed countries are more sensitized towards that, and therefore the clientele is more willing to onboard that, right? If I go to Africa, for instance, or India for that, there's a lack of existing infrastructure for adoptability of a new technology can really fill that space. And the best example of that is phone payments, right? Kenya was the first country the best country to invest in for phone payments because there wasn't that financial infrastructure in place, right? So a lot of insurtech, maybe a lot of fintech might be a better opportunity to invest in an African startup rather than a European startup where there is an alternative, you know? So that the type of startups that you choose in each location is different. The risks are always there again, and it's about, if it's really early stage, it's about the team that you have to get that confidence with.
Makes sense.
Thank you, guys.
Hey, Karim, I mean, would you like to share your experience if you have done any private investing? I mean, how do you come across it? And please go ahead.
Yeah, so absolutely. So I think Alex has to leave as well, so I'll try to go a little bit quickly. But yeah, essentially, demo days are a great source of deal flow. Talking to the founders afterwards, using the INSEAD network, exactly like what you said. So for example, a couple of investments I did in Africa were Cheaper Cash. There was Yassir. There was a couple more of those where, again, the INSEAD community in those countries really helped me in understanding who the founders are, what they've done in the past, what type of connections they have. So I have a lot of experience in the DRC in Congo for my own startup. And so it's a chain of hospitals. So I have 6 hospitals now in Congo. And I know that it's all about relationships. So I know what to look for in developing countries. I had a good, very good, so an INSEAD startup, Stan Plus. right, in India. So that was a very good experience for me as well. A couple more in developing countries, maybe Airlift in Pakistan, which is like the DoorDash for Pakistan, which was also via the INSEAD community. You get to find who the owners are. And I think for Airlift as well, one of the founders is an INSEAD alum, if I'm not mistaken, right? Besides that, it's via all these platforms that you guys spoke about or alluded to, right? That are available in North America. So find details there, all these syndicates, the RUVs, the this, the that. Try to understand, what's available, understanding who the founders are, market fit, and so on and so forth.
I think this is very helpful. At least I know, like, that if I need to, there is an echo from your side, Karim. Just could you mute just?
Oh, I'm sorry. Let me mute.
Yeah, I think if I need to go to Congo and Africa, I think you are my guy, man, Karim. I mean, I'll come to you and ask you, okay? Because yeah, I mean, it gives me confidence because you are doing startup there. I mean, so you know exactly, and this is exactly, and like Alex mentioned, that there are a lot of opportunities. When I lived in Nigeria, I mean, I saw the opportunity. I mean, like the INSEAD guys were doing. I mean, I saw that. I was thinking, like exactly Alex said, that you feel that this idea make a lot of sense in this country, but may not work anywhere else. But in this community, it is probably the one of the best. Like the Kenya. I mean, in terms of comes up like the phone payments, and we saw in India also, like when the Paytm and all these things. I mean, I could never imagine like going 10 years back, Indian people using phone for payment. I mean, nowadays, when I go back and I don't use phone payments, and I look like old generation because I mean, like yeah, it is like that.
Yeah, the one maybe the one thing that does bother me about those investments is the liquidity part of it, right? I mean, at what point and how much liquidity will there be for exits? So it's definitely something that bothers me. But it's this is the world of investing in startups, right? It's part of the risk.
Yeah, but I think I mean on that scale, I have an INSEAD alum that set up a startup in Kenya, and he eventually listed that startup in Amsterdam, if I'm not correct. So once the startup actually expands, or if it's later stage, if you're doing a round A, round B, it doesn't mean that you have to find solutions of listing in that country. In the end of the day, you can set up a holding in another country and eventually list it there. And there's more and more appetite for developing countries.
Yeah, I think that's helpful. I'll keep that in mind, Alex. For my startup, if I need to come and list in Switzerland, I think that's
you have to do the holding, yeah.
Yeah. So yeah, I think just one last question before we conclude, and I'm not sure whether you guys are comfortable sharing. Is there any particular company or
Myself.
you are most excited at this particular time?
I've got my own startup, which I'm very excited about. Like I alluded to in the beginning, I think it's and again, when someone does a startup, there's a lot of bumps in the road, and if the only thing is about getting financial returns out of it, which is an important part of it, it won't cut, right? You have to be able to have an ultimate higher goal. And in the case of iKeep, I mean, we really think that we can change the consumer landscape to really drive change in consumer behavior and brand behavior, and eventually, help climate change. So we really think we've hit the nail on the head. And we consider ourselves, sometimes we joke about it, but we consider ourselves the inverse of Amazon, right? Whatever Amazon does one way, we do it the other way. We bring products back to the brands. And at the same time, we are the green Amazon. So, we help avoid products going to the landfill.
No, it makes sense. So just one last thing. I mean, I agree with iKeep, and I'm following the journey very closely. And the recent mention in the Swiss startup arena and the Microsoft Accelerator program. I think it's gathering really good press and solutions coming to it. So very excited about it and very happy to help wherever I can. I mean,
Thank you very much.
I mean, it's my pleasure. I'm learning with you and Petros a lot. I mean, how to do it. Hopefully, all this will come helpful and handy. I think that's all from my side, Alex, today. I mean, yeah, I think really appreciate for your time. I think it's very helpful because a lot of people have asked these questions and I was answering, and you were answering these questions one at a time. So I thought let's put it together in one discussion so that everybody can access it. Okay, I really
I know. Thank you very much for organizing, and it's not easy being. I mean, it's my opinions. It's not written in stone, but hopefully this will be an impetus for others to start the conversation, which is, I think, something important for us as an INSEAD community to come together and share this knowledge. I think it will help us all.
Yeah, and disclaimer for everyone who listens this video is, I mean, these are just some few friends and INSEAD Alum discussing their own journey in the private investing. This is by no means a financial advice. You should do all of your own due diligence and do all whatever is needed. Private investing comes with different kind of risks that we discussed. It's not suitable for everyone. It's not available for everyone also. So yeah, I mean, just keep these things in mind. Okay. Thank you, everyone. Really appreciate it.
Thank you.
Okay, bye.